Okay, so we'll kick off. So again, good morning, everybody, and thank you for joining. I'm really pleased to welcome everybody to our quarterly call. This is the second of four, which is looking at our latest findings from the Robert Half Jobs Confidence Index in partnership with CEBR, which is the Centre for Economics and Business Research. So this morning, we're lucky enough to have Josie Anderson, who is a managing economist at CEBR. And at the end, there will be time for some questions and answers, which you can put any questions that you have in the Q&A section. So before I start, I'd like to share some of the reasons why Robert Half have commissioned this unique study. So while business and consumer confidence are regularly measured, analysing worker confidence through macroeconomic lens and the context of job creation, security and career progression can reveal deep insights into the state and stability of our labour market. Although traditional measures of the labour market health, like unemployment, job vacancies, they're very valuable, the figures alone are not really enough to understand the UK's increasingly complex labour market. So that's why we've partnered with CEBR to create the quarterly Robert Half Jobs Confidence Index. So as a colleague once said to me, trend is your friend. And keeping a finger on the pulse of current trends, employers can create a more purposeful talent acquisition and learning and development strategy, whilst job seekers and employers can make far better informed decisions on how their goals, maybe on remuneration, working models, and a hot topic of flexibility, as well as maybe skills on progression, and they all fit within the wider picture. So with that, I'd like to introduce our guest speaker and an author of the report, Josie Anderson, who, as I mentioned earlier, is a managing economist at CEBR. So as an economist on the macroeconomics team, Josie analyses and authors bespoke reports, also comments on labour market trends. So some recent work includes research into the UK productivity gap and forecasting the impact on employment of the fourth industrial revolution. So she's regularly interviewed on Bloomberg, and you may have seen her on the BBC. So we're delighted that she took our call last year and has agreed to work with us on the Jobs Confidence Index throughout this year. So thank you very much for working on the report, Josie, and I'll pass over to you.
Thanks a lot, Gareth. Yeah, it's great to speak to you all this morning at what comes at a really interesting time for economics and for the labour market in the UK. So I'll share with you the report that we've written. This is, of course, yes, the second Jobs Confidence Index report that looks at an amalgamation of labour market indicators, including ONS indicators, but also our new survey-based indicators to show how workers feel about the UK labour market. And so this slide is a rough outline of the methodology that we use to build this new index that we're running for the second time that was released earlier this month. And so it incorporates 4 different elements that we think are the key factors that contribute to jobs confidence in the UK. So there's job security, obviously, how secure you feel in your job, pay confidence, job search and progression confidence, and then more general macroeconomic confidence. And I'll talk a bit more about what feeds into them in a minute. But the way the index works is, as you'll see, it centres around 0. So 0 is the long-term average level of confidence in the UK economy over our long-term back history of the data that we've got. And so it can be above 0 or below 0. And typically it falls in a range of plus 30 to minus 30. And if it's above or below that, then it signals very high labour market confidence or very low confidence. And it's never taken a level higher or lower than plus 80 or minus 80. So those would be very extreme numbers. So to take you through the 4 pillars a bit more, so in terms of what goes into job security confidence, we've got the unemployment rate, labour market tightness related to vacancies, levels of temporary work, and also a survey-based indicator on future employment confidence. And then our second pillar looks at pay confidence, so it incorporates things like real wage growth, productivity, pay gap, so how unfair people feel the labour market is, and then also how secure they are in their pay. And then we've also got job search and progression, so it looks at how easy it is to find a job, but also how easy it is to progress in your career. So we've got another survey-based indicator in here that looks slightly longer term. How do people feel about their career over the coming 5 years? And also other indicators like how many people in the UK are in part-time work but want to be in full-time work. And then we've also got more general UK macroeconomic confidence. So it looks at this from two angles: consumer confidence, how confident employees and more general consumers feel in the UK economy, and then similarly how businesses feel in the UK economy. So to show you the results for the latest quarter, so this June report covered data for Q1 2023, the first 3 months of the year. And as you can see on this chart, the red line is the headline result. So you can see in the back history, it was very low for a long period after the global financial crisis, then started to increase, of course, declined amid the start of the pandemic, in particular as people had a great deal of economic uncertainty, but then actually in the bounce back from the pandemic, we saw very high, the highest levels of jobs confidence in this 15-year period that we're looking at, and so then since then it has moderated. Obviously, there have been fears about a recession in the UK and across the world for at least the last 18 months as inflation and the cost of living crisis has become a greater and greater theme. And so we did see a decline in the jobs confidence index, but it has bounced back this quarter to a level of 29.4. So what's feeding into this? Well, in terms of the 4 pillars that I just outlined, we've seen in the latest data that 2 stood in positive territory, and that was job security and job search and progression. And then pay and macroeconomic confidence stood in negative territory. Although there have been some movements compared to last time, macroeconomic confidence in the last 4 months of 2022 was even more negative. So there has been a positive movement despite its continued negative figure. And so to rise to stand at 29.4 in Q1 2023, as it says on this slide, this is actually the highest level since Q2 2022. So it's quite a positive reading. That's a 9.5 point rise compared to the Q4 2022 reading. So to think a bit more about the movement in each of these 4 pillars, in terms of what was strongest, it was actually job security confidence in the first 3 months of the year. And this is actually at 104.3 for that pillar. It's its highest on record. So people feel very secure in their jobs at the moment. And the next strongest reading was the other positive pillar, which is search and progression confidence, which also rose on the last quarter. Macroeconomic confidence, as I've already mentioned, it still stands in negative territory. People don't feel very confident in the general UK economy, but yet there was a substantial rise compared to Q4. And so in the end, only 1 pillar fell in the latest data, and that was pay confidence. And I'll go into a bit more detail as to why we've seen those movements on the coming slides. So job security, this slide kind of goes into a bit more detail on why we've seen this movement. So this is the most positive pillar. It's a really high score of 140.3. Again, it centers around 0 like the whole index, so it can fall below 0, but it's standing at a really high level of 140.3. And one of the key reasons why we've seen a rise in this pillar is actually the survey-based indicator. So last quarter, 53% of employees that we surveyed said that they feel secure in their jobs over the next 6 months. But this has risen now to 62% of employees so that they feel confident in their job looking to the next 6 months. So people actually feel pretty confident that they're not going to get fired, that their job is not going to be lost, the company is not going to make them redundant. A more negative reading, the unemployment rate has ticked up slightly, which has a negative impact on this pillar, but still at a slight rise to 3.9%. it's still very, very low compared to historical levels. And so despite evidence of a slight loosening in the labour market, it's still very tight, and unemployment is quite low. And the number of vacancies per jobless individual also declined in Q1, but the overall number of vacancies remains very, very high. And so overall, the picture for this pillar is very strong. Moving on to pay confidence. So this was the most negative reading, and I think that makes a lot of sense. I don't know about you, but I've been experiencing high levels of inflation. You know, food in the shop has become a lot more expensive. Heating the home has become a lot more expensive, but your wages might not necessarily have been rising at the pace of these expenses. And so that means people feel quite negative about their pay. And actually, there was one key positive movement in the pillar. Job earning security improved in the latest data. So a smaller share of workers reports having unpredictable wages, which might be due to the tightness in the labour market at the moment. Kind of employers are trying to get people to stay by giving them more secure contracts. But of course, real wages, so wages adjusted for inflation, have been falling quite a lot recently due to the high level of inflation. And so even though nominal wage growth, so that means before adjusting for inflation, is quite high, inflation is even higher. There were also quite poor figures for labour productivity growth, which has been quite weak in the UK for actually a long time. It's a big issue in the UK economy, which is linked to wage growth. If you don't have productivity growth, employers can't really afford to pay their workers more over the long term. And also pay variance, so basically pay fairness against standard, comparing similar jobs to each other, also worsened slightly this quarter. So this was the most negative pillar, which kind of fits in with the whole theme in the economy that we're seeing at the moment. People are experiencing real wage cuts and they feel quite negative about their wages. Job search and progression confidence was the other pillar that stands in positive territory, so higher than the average of the back history, at 35.2 in the first 3 months of the year. So there was another survey-based indicator in here. People saw a slight rise in their confidence in their career. So looking over their future career prospects over the next 5 years, 45% felt positive, which is up from 43%, so a slight rise on the last quarter. Also, there's been a slight improvement in activity in the latest data. So this is the share of people who aren't in work but also aren't looking for work. So they're not unemployed, they're just inactive, and there can be all sorts of reasons for this. Might be positive, it might be that they've become a student and so they're gaining new skills, but also it might be because they're long-term sick or they took early retirement because they feel down about the general state of the labour market. But this has actually improved. There's been lower levels of economic inactivity, and I think that's due to probably due to the high rate of inflation. More and more people think, oh, I actually do need a job to survive in this tricky economic environment. So to move on to the next one, the final pillar is macroeconomic confidence. And of course, looking at the back end of last year, it's, you know, we had the mini budget, which did really affect confidence in the UK. Obviously, there was this big movement in gilt markets, and now we're seeing actually gilt markets rise again, with gilt yields rising on the expectation of higher inflation and higher interest rates. But there was a big shaking confidence at the end of last year, around the time of the mini budget, and also great fears at that time that we were going to see a recession in 2023. But since then, people have actually become a lot more optimistic on the UK economy. We seem to have got through the worst likely of the cost of living crisis. It's certainly not over, but inflation has come down from its peak of above 11%. And is expected to continue falling, although didn't see that in the data yesterday, but we're fairly confident that there'll be a decline in inflation in July. And so hopefully things will continue to get better. And at some point towards the end of last year, the consensus expectations were for 0.5%, 0.6% contraction in GDP in 2023, and now we're forecasting an expansion. So the overall confidence in the UK economy has improved a lot over the last quarter. So consumer confidence increased a lot, as did business confidence, as you can see on the chart on this slide in the bottom right hand side. And that means that though confidence is still below the long-term average, it increased a lot. So we have some data actually looking in particular at the tech industry. And so this shows some of our indicators which we included in the Jobs Confidence Index, but just for the IT, the tech industry. And I think this industry is very interesting because there have been probably the most negative headlines out of all of the industries in the UK about jobs. Because there have been redundancies, it's true, and the number of vacancies have fallen a lot. In this table in the right hand side, you can see that in Q1 2023, vacancies were a third lower than a year earlier. But actually, I think what that statistic doesn't show is that there was a huge rise in vacancies after the pandemic in 2021 and early 2022. And since then, I think businesses have realised that they were probably hiring too many workers, and that's why we've seen some redundancies and also vacancies fall by a lot, but actually not fall by as much as they rose post-pandemic. And actually, the average number of unfilled vacancies in the quarter still stands above 2019 average levels, so pre-pandemic levels of 44,000, and so now it's at 52,000 for Q1 2023. And so yes, we've seen a big fall, but it's a fall from an extremely high peak, and so there are still jobs available in this sector. People are still hiring, but there was probably too much hiring, I think, that we've seen from some of the redundancies. But tech businesses are still willing to take on new workers, even amid these uncertain times. And actually, pay growth in this sector has been very high, higher than the average. And also the average wages in this sector stand 80% above typical pay across all industries. And so I think that hints at some tightness in this labour market still, because workers are being paid so much more. So it must be that businesses are trying to attract them with higher wages. And so I think the situation in this industry isn't quite as dire as some headlines might suggest. And then we have some other data. For instance, the share of temporary workers in the latest data was 3.9%, which is a slight rise, but not a very large rise on the latest data. Productivity growth was up, so that's positive. This can fluctuate a little bit, but at a growth compared to a contraction in the previous quarter of data, it's definitely a positive story and hints that some of these wage rises might be sustainable rather than just kind of a short-term rise in pay that can't be paid in the long term. You know, we can see that annual productivity growth was 2.6% in the latest quarter of data. So I think, yeah, the overall picture of the tech industry is maybe not as negative as some headlines might suggest. And so now to turn to some of our forecasts for the labour market, as you can see on this slide. So as I mentioned before, kind of GDP growth in the UK was looking very negative towards the end of last year. We thought that in 2023 there would probably be a contraction, but now we're forecasting an expansion of 0.2%, possibly even 0.3% in 2023. And the picture for GDP growth in the UK has been sort of flatlining. We saw kind of 0.1% GDP growth in Q1, and we also saw that at the back end of last year. So very small levels of quarterly rises, but still more positive than, of course, a contraction. And so we haven't seen any, you know, 2 consecutive quarters of contractions. Q3 last year was quite weak, but since then we have seen growth. And so there is some resilience in the UK economy. This comes despite the fact that we are, of course, amid a cost of living crisis driven by high inflation. Real wages have fallen by 3% in the year to Q1 2023 and are expected to see an annual decline in Q2 as well. But actually, as we've seen in the latest labour market data, actually wage growth is catching up with inflation, which it's positive and it's negative. So it's positive in that people are now, going to be able to afford more if wage growth catches up with inflation. Then it's good that real wages are positive and in positive growth territory. At the same time, there are great concerns here about very high wage growth, over 7% in nominal terms, feeding into more inflation. So this is what the Bank of England is very worried about, is that there might be a wage price spiral where higher wages feed into higher demand, which just fuels inflation, and then higher inflation means that people go and demand higher wages for their employer, which is an economic theory that suggests that inflation can stay higher and spiral for much longer. So there are positives and negative sides of high wage growth, but we are forecasting that real wage growth will return to positive territory later this year. And there's already a lot of evidence that it's going towards positive territory, although it still is in negative territory. In terms of unemployment, we are forecasting this to rise. So that's the blue line on the bottom chart. So a very small rise to a peak of 4.3% in the second half of the year. So this possibility of a small recession that we're not forecasting, but the possibility of very weak GDP growth is not necessarily feeding in to people losing their jobs. You might see a slight rise in redundancies, but nothing large. And that is because the labour market is so tight at the moment. Through all of the economic difficulties that we've experienced already recently, there hasn't been a significant rise in unemployment. So we're not expecting to see unemployment rise considerably. And developments in vacancy numbers are also reflecting the continued tightness of the labour market. So vacancies are the orange line on the top right hand chart, and of course there was a big rise in 2021 and 2022, and they are coming down, and we're expecting them to continue to come down. So there's a peak of 1.3 million, but we are expecting it to stabilise at around 950,000. But this is expected, this still is far higher than pre-pandemic levels, as you can see from that line. And so vacancies are expected to stay quite high and reflect ongoing tightness in the labour market, as there are skill shortages in the UK, really. So that's to kind of summary up our findings for this quarter. So obviously it reflects, yes, a difficult economic environment, but lots of positivity. Workers can find jobs. Real wages are expected to turn positive, and we're not expecting a recession. But yet, of course, with the Bank of England expected to raise interest rates later, and the impact that will likely have on the housing market, there is a lot of uncertainty in the UK economy, and there's going to be many more months of the cost of living crisis, particularly for people on variable rate mortgages who will be hit by higher mortgage rates. So it's not an entirely rosy picture, but I think the labour market actually is the key source of strength in the UK economy at present. So I think now I'm very happy to take some questions if anyone has any. Oh, Gareth, I think you're on mute.
So apologies for that. So yeah, look, thank you, Josie. I think that was a fantastic insight. I certainly took some notes there myself, and a few things that I thought really were prevalent for myself. The job confidence index has increased, which I think was a surprise to myself. People feel insecure, but are slightly negative on pay. So there's a bit of a nominal growth on pay, but it's not accelerating anywhere near as fast as inflation. And the last point really is, tech 80% above the average. So in the industry that we work in, we're certainly seeing that as well. So the tech sector seems to be paying higher wages in order to attract and even retain their staff due to skill shortages in that area. So will we start to see that stretch into other sectors? Possibly. Rob Half was certainly seeing that from an interim worker perspective, and I think we are expecting that to continue into the full-time employee market. So look, thank you very much for that. So we have got some questions, and I've got a few which people have put into the chat. So I'll start with the first one. So In what ways do you think this continues to be a unique economic cycle?
Yeah, thanks. I mean, so this is such an interesting possibility of a recession. You know, we're not forecasting recession, but it could happen. Certainly, economic growth is very weak, and yet we're seeing very low unemployment. I think typically the way people feel a recession is by losing their job. That's like the worst thing that can happen for your finances, and that makes people feel hugely unconfident in the UK economy. But yet most people still have their jobs. The way that they're experiencing this recession is, of course, struggling to pay their bills, even though they do have a job. So this is not a typical recession where we're seeing mass unemployment. It's just people, even though they still have jobs, are struggling to pay their bills. They can pay some of them, but they might not be able to pay their mortgage in full. They might be struggling to pay their energy bill. And so it's quite different from, for instance, the global financial crisis, when we saw a big peak in unemployment. And of course, we saw labour market confidence remain very low for a long time after that. But yet with very weak economic growth, we're still seeing very high labour market confidence, and that is because people feel very secure in their jobs. When their employer is advertising really struggling to hire, they know that they're not going to be fired because their employer is struggling to fill the jobs that they have as it is.
Yeah, absolutely. Yeah, I would completely agree, and I think that, you know, again, at Robert Half, you know, we're clearly in that market, and our, you know, our clients are constantly looking for you know, new talent, skill shortages. So yeah, I would completely agree with that. So next question, what do you think is behind the trend we've been seeing quarter over quarter, where jobs confidence has been increasing despite the recent economic uncertainty?
Yeah, so I think it's kind of what I alluded to a bit in my last question, in that this labour market tightness means that people are pretty sure that they're going to be keeping their jobs. You know, we're seeing more workers being offered permanent contracts, and employees being confident that they won't be fired because their employer is already struggling to hire. You know, there's slight differences across industries here. You know, obviously tech is a weaker industry in terms of seeing that big decline as we discussed in vacancies, but some industries are really struggling to hire to a far greater extent than tech. You know, for instance, accommodation and food services is an industry, and also in particular human health and social work, they're really struggling to hire. So you know, they're not going to be firing anyone anytime soon unless they have a very good reason to, because they need the workers.
Yeah, absolutely. And I think, you know, retention strategies are just as important as traction strategies in this market. So yeah, absolutely agree. So given the decrease in pay confidence that we've seen in the report and an increase in jobs confidence, could this lead to employees seeking better remuneration elsewhere? That is to say, you know, an employer, as I just said, you know, a risk of losing their talent.
I think it is a risk, and it's interesting because the labour market is tightening a little bit, of course, as compared to a year ago. Loosening. Vacancy numbers are falling a bit compared to a year ago. But I think a recent report by PwC found that 25% of workers are still planning to change jobs this year, and I think it is because you know, most people expect a decent pay rise when they change jobs, and maybe they've asked their current employer for a pay rise and haven't got it because their employer thinks it's economic uncertain times. We don't want to be paying workers higher wages or a small pay rise when they were hoping for an inflation matching wage rise. So employees think, okay, I'll look elsewhere because there still are vacancies available, even though they've fallen slightly compared to a year ago. If they think that they can get a wage rise by moving, I think they will try, because we're seeing that pay confidence is quite low. And so if they're confident they can get a job elsewhere, I think most people would try. Yeah,
absolutely. And I think, you know, fears, you know, as you said previously, you know, fears on a recession have been knocking about now for nearly 18 months. And normally with that, you would see a decline in job confidence. But with the increase, it's definitely providing a very, very unique situation. So a couple more questions. So why should British British leaders continue hiring?
I think it's because they need workers. We haven't seen a recession and we're not forecasting a recession. The UK economy is kind of trundling on. We're not seeing amazing growth, but we're still seeing consistent output from the British economy. And to create that production, to create that output, we need workers to do the work. And so even though employers might be worried about things like rising interest rates and their impact on economic activity, as it is, economic activity is occurring, and for things to be produced, for services to be sold, you need workers. And so I think to suddenly stop hiring because of fears about a recession that might never happen would be bad for business.
Yeah, absolutely. So our report talks about over 50,000 open vacancies in tech. Each vacancy represents a potential or missed opportunity. This doesn't sound like the headlines we read about when it comes to tech. What are your thoughts on that?
Yeah, so I think it is true that in some industries, in some businesses in tech, that there have been redundancies and vacancies have fallen from a very high level. But at 50,000, they're still high. They're still higher than pre-pandemic levels. And so I don't think the situation is bad as kind of the doom-mongering headlines suggest. It's still possible to get a job in tech. And businesses are still hiring. I think it's still true that there's a bit of a skills gap, and so there are still persistent vacancies because not enough people in the UK probably still don't have the right skills for tech, and we still need to be doing things to get those tech skills up to scratch. Because of course this is the industry of the future. We're all worried about AI and the impact that might have, but the jobs are going to be in using this tech and in this industry. So I think even though kind of worries about the industry at the moment and the fall in vacancies, kind of that's a short-term trend. The long-term trend I think is growth in this industry.
Yeah, okay. And so how long do you think the trend of vacancies remaining above pre-pandemic levels will last, and why do you think that is? Yeah,
so I think there is some persistent tightness in the labour market that will go on for many years, and that we're expecting to see those vacancies remain high. And there are a number of reasons for this. Of course, you could say skills gaps, which could be due to something like Brexit, but also perhaps just due to the long-term changes in the labour market that people need to have the right skills for, and maybe there needs to be more training so that people have the right skills for the jobs that are being created. And I think there is a great importance of kind of being ready to fill the jobs that are available. Some industries might be seeing less need for labour and employees as technology becomes more useful, but there are definitely areas of growth, and you just need to have the right skills to be able to fill those jobs.
Yeah, okay. And I know we touched on inflation earlier, but what is CEBR's expectation for inflation trajectory, let's say by the end of the year?
Yeah, of course. So we are expecting it to continue falling. In fact, the surprise that came out in the data yesterday of inflation remaining at the same level as is in April, in May, wasn't much of a surprise for us. We actually anticipated that. Because in the UK, our inflation data is heavily influenced by the Ofgem energy price cap, which changes once a quarter. So we're expecting another big decline in July, and then another decline probably in October. And so we are expecting inflation to continue falling, but it can just be quite jolted, occur kind of once a quarter in line with the Ofgem energy price cap. Food prices have been very high, and we're expecting them to come down too, but at a slightly slower rate, but that will start feeding through at the end of the year as well. So we're expecting inflation to likely stand below 5% by the end of the year.
Yeah, that's good, and which will be welcome news from employers, because as salaries are on the increase, but again at nowhere near the levels that inflation's increasing. It will be nice for wages to maybe go up slightly and inflation to come down slightly, and we may actually get somewhere close. So that's welcome news, Josie, for most of the people on the call, I guess. So what potential risks do you think businesses, especially SME businesses, need to be prepared for in the next 6 months? And what do you think is behind the poor figures for labour productivity growth?
Yeah, well, I mean, so what's going to happen in the next 6 months? Obviously, interest rates are high, and we're expecting, even after today, possibly a couple more interest rate rises. And that's difficult for obviously anyone with a loan, businesses or consumers. So the big one is mortgages, but many businesses have loans as well. But also, even if you don't have a loan, I think these high interest rates are putting off businesses from investing because they don't want to borrow, which might make the most financial sense for your business. But at the same time, I think that can impact long-term output of those businesses. And so I think businesses have also got to think about the right time to invest, and whether or not it might be worth investing in something despite the higher interest rates, which of course would be a big decision. But I think we're seeing borrowing levels come right down for SMEs, which is a concern in terms of them having the right equipment, having the right tech, having the right, investing in the right things, having the right infrastructure for their business. And so I think these high interest rates can also, affect the long-term output, even though they might, be a shorter term phenomenon. In terms of productivity, that's a big question. Productivity growth in the UK has been weak for over a decade. And the reasons why, well, there's no consensus. To get productivity up, the classic things are reskilling, so making sure your workers have the right skills and sending them to training, and also having the right technology, having the right equipment in place for your business. And this interacts with those high interest rates, because people, if they're scared of investing because it's expensive to borrow, might not be investing in the right equipment for their business that would make it more productive. And so I think these high interest rates might worsen the productivity situation even more potentially.
Yeah, absolutely. And I was at a meeting with a client yesterday that works for an asset finance business, and they were saying that they're getting more and more inquiries around flexible lending resource as the bank's interest rates go up. So I think the confidence around those companies still looking to grow is there. It's just they're looking for finance options to enable that growth. So and then lastly, this is a question that's actually been asked by a few people. So as an economist, how do you define confidence, and how important is that within business growth?
Yeah, of course. So I mean, confidence in any context is faith or trust in something. So I think in terms of economics, it's trust in the future of the UK economy, trust in the system that you'll be able to have a job, that you'll be able to earn enough to get by. And so in the cost of living crisis, kind of that loss of confidence is related to kind of a loss of trust that you'll earn enough to cover your wages, and that you'll be able to afford your mortgage, and that interest rates won't get too high. And so obviously that's being knocked at the moment by those factors. So in terms of businesses and business growth, I think it's kind of similar. It's trust in the system, and fears about the future. And so I mean, in the context of business growth, I think confidence is so important for things like investment, like I was just talking about, businesses being willing to buy very expensive equipment, for instance, if they're worried about interest rates and they're worried about going bust down the line because of this big expense. But it is so important to invest for the sake of things like productivity and the long-term success of your business.
Yeah, absolutely. And then the last question, with the markets being volatile as they are, this quarter, with regards to the job confidence index, were you surprised at the results, or were they expected? And also, next quarter, what are your expectations?
Interesting. I think I actually was surprised at the extent of the rise. I think the recent trend has been falling, and I didn't think we'd see a large fall, but I think I was prepared for the possibility of another decline, because the labour market is loosening at a slow rate, but vacancies are coming down. For instance, unemployment is rising slightly. obviously the macroeconomic confidence has risen actually, despite the tricky situation. So I always expected that to rise a lot in Q1, and I think it could possibly rise a bit in Q2 as well. But it's interesting because we produce our own indicators for consumer confidence, and even in the more up-to-date data, so the data we have for May, it continued to rise. And I think there's probably a correlation between general consumer confidence and confidence in the labour market. Yeah. And so I think it could rise again, actually, possibly in the next quarter. But it is factors like that wage growth and the possible slight loosening in the labour market that could have a dampening effect as well. So from a quite strong level, I'd be surprised if it rose a lot. We'll see. But I think the macroeconomic confidence is expected to continue rising, and that will have a positive impact next quarter.
Yeah. Good. Well, hey, regardless of the size of growth, we like growth. So so that's really, really good to hear. So look, that brings our webinar to a close. So look, Josie, thank you very much for those insights. I think when you look at the data, it certainly helps us to understand where we are from a again, job confidence index and economic cycles and what the impact that's having. So look, hopefully everybody's found that as insightful and helpful as I did. Thank you for joining. We clearly have got another webinar next quarter. We'll be sending out literature about how to join and how to register for that shortly. So again, thank you to everyone for joining. Josie, thank you for taking the time to share your insights. Hope everybody has a good rest of the week, and we'll see you all soon.